Morning, everyone. We'd like to call the Investment Committee meeting to order. First order of business will be to call the roll.
Rob Fechner.
Good morning.
Teresa Taylor.
Good morning.
Margaret Brown.
Here.
Henry Jones.
He'll be here.
Fiona Ma, represented by Matt Seha.
Here.
Lisa Middleton.
Present.
David Miller.
Here.
Stacy Olivares.
Here.
Irena Ortega.
Here.
Jason Perez. Mona Pascual Rogers.
He'll be here.
Roman Rubalcava.
Here.
And Betty Yee.
Thank you. Item 2 is the approval of the November 18th Investment Committee timed agenda. It's been moved by Taylor. Seconded by Brown. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
Opposed, no. Motion carries. Item 3 will be the Pledge of Allegiance. Could you all please rise and face the flag? Hand over heart. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. Item 4, the Executive Report, Chief Investment Officer briefing. Mr. Meng.
Thank you, Mr. Chair. Good morning, members of the Investment Committee. In addition to the standard recurring items, this morning in the open session, we have item 7A, where we ask you to approve the scoring of the subcommittee of the board on the selection of the independent board consultant. And then on item 8A, we'll bring back to you the second reading of the investment policy revision of public assets. If you recall, the last time at the investment committee, we brought the first reading to you. In item 9, we'll continue the annual program review, and this month, today, we'll cover the 2 private asset classes, namely private equity and real assets. If you recall, in August, we brought the annual program review of TLPM, the total trust level fund function, as well as OS with Opportunistic Strategy Group to you for review in August. And the last time in September, we brought to you the 2 public assets, the public equity and fixed income. So item 9 today is a continuation of the annual program review. In item 10, we're going to have the first reading of the program policy revision of private asset classes. And in item 11, we have 3 items. 11A is affiliated trust fixed income benchmark update. 11B is our update on sustainability investing. And then 11C is our annual update, CalPERS for California. So with that, back to you, Mr. Chair.
Thank you. Brings us to agenda item 5, the action consent item. It's the 5A approval of the September 16th meeting minutes. Moved by Taylor. Second. Seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
Opposed, no. Motion carries. Item 6, information consent items. Having no request to remove anything from that agenda item, we move to item 7, the independent oversight, the board investment consultants. That I call on Mr. Bienvenu.
Thank you, Mr. Chair. As you recall, a subcommittee was delegated from the investment committee to work through the interviews with the board investment consultants. Recall that we're looking for consultants in the category of general pension, private equity, real estate, and then infrastructure. As a result of those interviews, we have a set of scoring, and what we need from the committee is to approve the scores and then create the notice of intent to award such that subject to successful contract negotiations. So in the category of general pension, the leading score was Wilshire. They had 651 points to their interview score, which brought them to a total of 1,001 points, and that's the highest scoring finalist in the category of general pension. In the category of private equity, Makita scored 700 points to their interview score, which got them to a total of 970 points, and they are the highest total in the private equity consultant category. For the real estate consultant, Makita again scored 700 points for their interview, And again, we're the highest score overall in the category with 1,043 points. And then in the category of infrastructure consultant, Makita again scored 700 points, which brought them to a total of 1,050 points. And again, they were the highest scoring finalist. So the subcommittee's recommendation is that the investment committee approve the scores, and then subject to successful contract negotiations, award Wilshire as the consultant for general pension, and then Makita for private equity, real estate, and infrastructure. And with that, I'll pause and turn it back to you, Mr. Chair.
Thank you. So we need a motion to approve the subcommittee scores. Moved by Jones. Seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye. Aye. Opposed, no. Motion carries. Anything else you need on that, Mr. Bienvenu?
Nope, sir.
Very good, thank you. Brings us to agenda item 8. 8A, a public asset class, second reading of the policy and delegation. Mr. Meng.
Yes, I'll turn over to my colleague Kate.
Good morning, Kit Crocker, CalPERS staff.
Morning.
Item 8A is a second reading of staff's proposed changes to the program policies for global equity and global fixed income arising out of this year's annual review. These are primarily intended to reflect the introduction of segments for these asset classes. As you'll recall, of course, for the global equities portfolio, that would be the split into cap-weighted and factor-weighted segments. And for global fixed income, the segmentation into treasuries, spread, and high yield. And as typical with these annual routine updates, we're also proposing some cleanup changes. Since this is a second reading, we are seeking action from the committee at this time. So with that, I'll pause and see if we have comment from the board's consultants.
Good morning, Tom Tote with Wilshire Associates. We provided our opinion letter on the initial reading. There have been no substantive changes there. We remain comfortable with the changes as proposed.
Thank you. Ms. Brown.
Thank you, Ms. Crocker. I know this is the second reading, and I like this because it gives us a chance to look at it again. So I had a question about attachment 2, page 4 of 9. And maybe this also could be for our consultant. And I'm looking at table 1 where it looks like item 2 we're removing. And by the way, thank you for putting the marked up versions on here so we can really see what we're removing. I have a concern that we're removing, maybe we're not, maybe it's somewhere else, that the staff shall report concerns, problems, or material changes and all violations of the policies. And it says at the next committee meeting or sooner if deemed necessary. So is that gone completely? And then does that mean that the board won't hear about problems or material changes, or is it somewhere else in the policy?
No, definitely not. I'm glad you asked. Since staff's obligation to report these policy violations is now stated generally for all asset classes in the total fund investment policy, we're just making the conforming changes to the program policies to remove that because it's now redundant with what's in the total fund.
And so it's somewhere else in?
It's in the total fund investment policy, yes.
Thank you. All right. Thank you.
All right, thank you. Seeing no other requests, what do we need here? We have a motion before
Seeking
you?
action, yes, please.
All right, second reading. So what's the pleasure of the committee?
I'll make a motion.
Moved by Taylor,
Second.
seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
Opposed, no. Motion carries. Thank you. Agenda item 9, information agenda items. Real assets, Mr. Meng.
Yes, thank you, Mr. Chair. As I said, this item covers the annual program review of the 2 private asset classes. We'll start with private real asset first, and then followed by private equity. And as you noted, that each one item is paired with a consultant review as well. So with that, I'll turn over to my colleague Paul.
Thank you, Ben. Good morning. It's a pleasure to present the annual program review for real assets. I'm Paul Muchaka, and I'm joined by several members of the real assets team behind me. I want to emphasize that the deck was a total team effort. Thank you, Ben. So the role of real assets is to provide the total fund with stable cash yield, inflation protection, and diversification of equity risk. Over the course of this business cycle, the real assets portfolio has transitioned materially. 10 years ago, it was not aligned. 5 years ago, it was somewhat aligned. And today, the portfolio is significantly aligned with its role. That transition has taken time. Most importantly, it has required strong support from the board, as well as energy and focus of the staff. The strategy employed by staff entailed two competing objectives: prudently winding out of legacy or non-strategic holdings while acquiring core, high-quality, well-located, essential assets. These core assets are aligned with our role and are performing well for the total fund. In essence, the strategy is right. In keeping with Ben's 4 Ps, today I will discuss our program in terms of performance, portfolio, people, and process. So beginning with performance, after 2 consecutive years of strong absolute and relative performance, returns for real assets slowed in fiscal year 18-19 to 3.7%. However, given the illiquid nature of private real assets, more emphasis should be placed on longer-term numbers. The real assets portfolio generated 5-year performance of 7.5%, lagging the benchmark but exceeding the actuarial rate of return, as well as the ALM capital market assumptions. Underperformance was the result of non-strategic legacy assets such as forest land and non-core real estate. What powered our performance, however, were the core holdings in real estate and infrastructure. The core assets in our portfolio generated a 9.8% return for the same 5-year period, outperforming the benchmark. Moving to our second P, portfolio. Over the past 5 years, our core exposure has grown to 85% from 46%. This was nearly $30 billion of investment activity and portfolio growth. Our core program was grown by approximately $20 billion through acquisition and value change, while our non-core or legacy holdings were wound down by approximately $10 billion. This dollar movement is significant in a market such as real assets. Lastly, our infrastructure portfolio has now hit approximately $5 billion, and staff has put in place a repeatable business model that will allow infrastructure to continue to grow in a disciplined manner. This leads us to our people and process. It's these 2 ingredients, after all, that make things happen. Our team is skilled and united while operating in a well-organized and risk-aware process. The team's hard work over these 5 years has had a cumulative effect of bringing us to a much stronger position. Real Assets has successfully implemented a disciplined framework of underwriting and a business model whereby separate accounts with strong governance, ESG integration, and reduced fees now dominate the makeup of our portfolio. Further, this business model has not inhibited us in execution. CalPERS has a strong brand and reputation in the market and access to best-in-class partners. In conclusion, Real Assets recognizes performance was not strong over the past year, but it has not deterred our focus. It is important to maintain consistency, which means paced deployment, disciplined underwriting, and sound internal oversight. Consistency and discipline allow Real Assets to continue to provide its role to the total fund. We remain committed to further aligning the portfolio with the tried and true strategy that the board approved that has served the system well. Thank you, and we welcome questions.
Thank you. Ms. Taylor.
Yes, thank you. Thank you, Paul, for your report. It was very good. I had one question on the forest land and non-core. It sounds like you're winding that down. When do you have an expectation that that won't be such a drag on the portfolio?
Good morning, Ms. Taylor. That's a very good question. As we speak, we have been working on exploring other ways to speed up the transformation for our real asset portfolio to more core. But due to the illiquidity nature of these assets, it has been a slow-moving process. But we plan to bring back to this committee in December with a plan how to speed up the transformation process, so that we can put this behind us, and then the staff, as well as our capital, can focus on more area with higher potential.
Thank you. And I have an expectation that I think, and this happened way before I was on the board, but forest land was purchased thinking that we would be dealing in, I guess, timber, right? That has not materialized, and that's why the loss, or it's just not I'm not clear on.
The thesis around the forest land portfolio predates, I think, virtually everyone sitting at this table, but it was part of the ILAC program, the inflation-linked program in 2007, I believe. And then, so these purchases were made at that point in time with the notion that this would provide some inflation protection. Now, it's not a condemnation on the timber industry. It just, our holding that we sold last year was a very challenged investment for CalPERS.
And then I assume the one we're currently holding still is as well.
The one that we currently hold has not performed nearly as badly as that one. That
Okay.
one is.
But it's still a drag, it looks like, as I was
It has
looking
been a
through.
drag compared
Yeah.
to the benchmark, correct.
Go ahead, Ben.
Yeah, and exactly as you just point out, a number of we call the legacy assets, the investment were made a long time ago, some 10 or some even 20 years ago.
Got it. Then my last comment is AB 547 has passed, and it's the janitorial bill that provides that our custodians that are employed in our buildings are able to do sexual harassment training. And I'm just hoping that the folks, our managers that we're dealing with, are making sure this is taking place. And I just wanted to have you talk about that.
We will contact our our separate account managers and find that out for you.
Yeah, I'd appreciate it, because it is now the law, so
Yes.
we have to make sure that does happen. Thank you.
You're welcome.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chair. Yes, thank you for the report, Mr. Machaka. My comment goes to the infrastructure presentation, and as you said that you will be utilizing some discipline to see if we could increase our allocations to infrastructure. And looking at the net returns over the 1, 3, 5, and 10 years, they've all been very positive, outperforming the benchmark, et cetera. But we also have been talking about doing more in infrastructure for a long time now. So why haven't we seen any progress to allocate more to infrastructure? Because at least 4 or 5 years we're saying we're going to do more. Because it was such a high returning asset for us.
So within 4 years, our infra program has grown from $2 billion to $5 billion. So it's about $1 billion a year that we have been deploying or growing the portfolio, mostly through acquisition and deployment. It took us a couple of years to just establish the business model in terms of setting up, finding the managers, setting up the governance. In the past year, we have now deployed into one open-ended fund and established 2 separate account vehicles that are designed for us to be in a better position to deploy capital. We are committed right now. Our numbers state that we're at $4.8 billion. However, what's actually in the ground but not called yet would take us closer to almost $6 billion. So we have been deploying at roughly about $1 billion a year over the past 4 years.
Mr. Jones, in addition to what Paul just said, there are 2 other reasons. One, the infrastructure deal flow is lumpy. It doesn't come all the time, but when it comes in large size. So we need to get our processes ready internally, which we are. Then the other reason is that there have been increasing demand for core infrastructure assets. And our underwriting standard, our return target, a little bit higher than other investors. So make us less, in a way, we are less price competitive in the marketplace. But given that challenge, despite of that challenges, the team continue to look for ways, to utilize or take advantage of our scale and brand name, so that we can invest in deploy more capital into core infrastructure projects.
Okay, thank you. And so do we have a specific target as we do with private equity? We indicated that we need to deploy $10 billion a year going forward. So do we have a similar target for infrastructure like that?
For infrastructure, we do not have a specific target for infrastructure, but infrastructure is part of the real assets now. And real assets target is 13%, currently about 11%. So similar to private equity, we have been struggling to get to our target. Private equity target is 8%, and currently we stand at 6.9%. So we realize the benefit of private assets to our portfolio, but same times we also realize the challenges or constraints we face in today's market environment.
Okay, thank you. I appreciate the comments, and it's just that it's such a high-performing asset, and why can't we get more money? It's kind of like private equity. We need to get more money out there because that's where we're going to get the returns. We need to pay our benefits. So thank you for your comments.
Thank you. Ms. Brown.
Thank you. Mr. Machaka, can I call your attention to attachment 1, page 6 of 26?
Attachment 1.
And I just had a question about these valuations, or how we come up with these net returns. So when we look at real assets, they're at 3.7 and they underperformed. But I want to go all the way down to forest land, which is negative 10.7%. So, and the asset value is 1.3 billion. So what we don't see here is what it was, what the asset value was last year, or what changes occurred. Do you prepare those tables, and can the board see those to see, like, if we purchase, let's just say for forest land, I know we didn't purchase any, but if we sold any forest land, what the changes in valuations were, which caused this negative almost 11%? Or is it just based on valuations? Basically, you get new valuation that the land has dropped, or the value has dropped 10%, and that goes in there. And my concern is that if the managers are doing the valuations, how are we checking that those valuations are real? Is there a third party? Is there a third party audit of those, or is there a random audit of those valuations? Just concerned, because I think we pay a lot of our managers based on assets under management. And so it would be nice to know that we're just not relying on their valuation, that there's some third party. So I know there's a lot of questions in there, but just curious how you get to that table.
So with respect to your first part of your question on forest land, we sold our largest single holding in forest land last year. So our net asset value, I believe, was closer to 1.8 or 1.9 billion. Last time I presented the annual program review, we can confirm the precise number, but it's closer to $2 billion, and therefore what's shown as the change in value was really mostly the sale of that asset that caused the negative 11% return and caused the drop in value. Now, if I can call your attention, Ms. Brown, to page page 18. On the far left bar graph, this shows the proportion of our holdings that are in separate accounts, whereby we have some control features. There today, we stand at a little over 90% of our portfolio is in separate accounts. Virtually all of that 90% we appraise through our internal CalPERS valuation policy. The other 9% that's in these commingled fund type of vehicles, they tend to be valued the way based on a manager with an audit firm.
Great. So what about tracking, almost like a general ledger where you show the ins and outs? How is that tracked in your office? And at what point can maybe the board take a look at that? Or I would like to take a look at that. Sort of the purchases and then the declines in value?
In terms of how we track it, we look at, there's a schedule that we look at every quarter that is the cash flow, the contributions and distributions, so plus and minus, and then whatever would be the income plus the we hope for the plus of appreciation. And then that gets you to your ending, and we look at that movement, or we call it our continuation schedule every quarter in terms of how the flows and the valuations move in our portfolio.
I'm not sure if anybody else would like to take a peek, but I would just like to see how you come up with that final number. That'd be great. Thank you.
Thank you. Ms. Oliveris.
Thank you for this presentation. It's very thorough. I had a couple questions about the 1 year versus the 3 year performance on page 15. So it looks like the 1 year benchmark was 6.5%, and the net return for CalPERS was 3.7%. But then I look at the 3 year, and it seems like the performance was much better, with the benchmark being 6.8%. And CalPERS net return 6.4%. Could you please walk me through what happened between the 3 year and the 1 year?
Sure. The 2 previous years, our performance was over the benchmark. We had 7.4% 2 years ago, and we had 8% last year. Our performance was slowed by 2 major factors this year. One was the sale of that timber asset that we brought up earlier. That pulled down performance quite a bit, but that was one that we expected. The second is a point that Wilshire has actually brought up in last month, as well as Makita, which were our retail portfolio took some valuation write-downs, and we did that ahead of the benchmark. And I believe Wilshire pointed out not last month, but August, in the August IC, that we were more or less ahead of the curve. We now have 2 quarters that have been booked in our benchmark, and that benchmark has begun to take its write-downs in the retail arena. It did not take them last year, and so therefore they're more or less catching down to where we are, and our retail has stayed relatively flat for this fiscal year. So that last fiscal year, we took the timber sale, and we took valuation write-downs in our retail that caused us to have a much lower return, whereas the benchmark for that up until the end of our fiscal year had not recognized nearly the amount of hit on retail that we did.
And what are we projecting for our performance this year versus the benchmark?
We don't.
We don't really have a projection. We don't project our year-by-year return. But if you were referring to capital market assumptions, so every 4 years we do formal capital market assumptions, and then in between, when there's new information coming in, we try to update our capital market assumptions at the midpoint. But we do not, for each asset class, we do not do annual return projection.
That's different. I also had a question about governance. So I saw that enhanced governance has increased to 91%. Is that with the different ESG factors that were included in here?
Which slide are you
I believe that
pointing?
was that page. It might be page 6.
Page 6? Yeah. So our separate accounts, Ms. Oliveris.
Sorry, page 12.
Page 12. Right. So our separate account model that we run in real estate and now in infrastructure that we've implemented a few of these. There's a few, beyond the control features we have around the pace of investment, the capital and the leverage. We also have implemented some of the important ESG initiatives through that governance model. One is our energy optimization program within our real estate program. And then our ESG matrix, which is a framework that all of our separate account managers must put together for us to assess various ESG type risks around maybe climate or water or social issues that may be pertinent to that particular asset. We've integrated that through that separate account model where we have the ability to do that.
Thank you. And then I see that there are 26 external managers. Do we anticipate that there will be so many going forward, or are we going to try to narrow down the manager pool at some point?
So roughly 4 years ago, I got here and we had 68 internal managers, around 68 managers within real assets. And that number has been wound down considerably through a lot of this, the 10 billion that I reference in terms of the sale of non-strategic legacy assets. So it's been narrowed down quite a bit. We don't anticipate it to really move dramatically down or dramatically up from that number at this point in time.
Thank you.
Thank you. Ms. Yee.
Thank you, Mr. Chairman. And I have some ESG-related questions as well, if I may. I know the real assets carbon footprint portfolio will be completed, I think, within this next fiscal year, and I was curious as to whether the findings of that effort will be brought before the committee at some point. And the reason for the question is just to understand how that might impact the, I use impact as a verb, how that might affect the investment strategy and things like, change in geographic preferences and areas of focus.
It's linked in our climate risk report, but we'll ask Beth to take on the question more directly.
Great, thank you.
Good morning. Beth Richtman, Sustainable Investments. The Sustainable Investments team has worked very closely with the Real Assets program to complete the carbon footprint on the timeline, I guess, set forth by our strategic plan. And so we do have findings on this. And I will say that the work that we put in place over the past several years within the Real Assets program, using GRESB as a tool and working with all the managers using this important governance structure that Paul talked about has been instrumental in us getting the level of transparency and reporting that we needed to actually do the analysis.
Okay.
In terms of the findings, I believe that they will be put as part of the overall climate risk report that we will be delivering at some point, probably in early 2020.
Okay, great. That's fine. And maybe, Beth, while you're here, I have a question about forest land, and really appreciate the staff refining this area of the portfolio. Are there larger discussions with respect to any opportunities for forest land going forward as a potential for providing carbon offsets?
So I will say that that is an area of research. I think, earlier this year, the board approved new policy language in our governance and sustainability principles that talked about the importance of having a carbon pricing framework that incentivizes that type of natural ecosystem carbon sinks. Currently, the pricing in those frameworks and their focus on the ecosystem services, including carbon sinks, provided by natural ecosystems is not at a level where we see that as a place where we could deploy significantly, but that is an area that we're watching, and it's something that we look forward to policymakers developing the right policies around to create the right incentives for investors like us to be able to find those opportunities.
Okay, so that's going to be tied very much to the pricing and valuation policy work. Okay, got it. Thank you.
Thank you. Ms. Middleton.
Thank you, Mr. Chair. I'd like to go a little bit more broadly and follow up on some of the questions that Mr. Jones was asking. In terms of our broad allocation to real assets, are you satisfied with where we are at today?
You mean satisfied in terms of the allocation target?
And the total amount that we have in real assets.
So the short answer is no, we are not satisfied. But at the same time, we have to acknowledge the challenges and constraints we face. And with that, again, under Paul's leadership and then the investment management committee, the senior group, we are fully committed to deploying as much capital as we can prudently to private equity and real estates.
So,
I'm sorry, can I just make one comment also? Ben used the word prudently, and I think it's worth commenting on that, and this speaks to Mr. Jones' question also. It is, infrastructure is one of our highest performing asset classes, but it's because we've kept high underwriting standards. We could certainly deploy more, but that would mean reducing our underwriting standards, which could potentially mean reducing the return. So there's this balance between getting enough out, but getting enough out with the expected returns and the needed returns.
so projecting ahead, how long do you anticipate it will be before we have increased the value of real assets using the kind of prudent underwriting that we're approaching today? And again, in very broad terms.
In the infrastructure assets, again, as I said, that it comes in lumpy. So we're trying to find out ways to take advantage of our strengths, which is our size. So which also means that when a larger size deal comes to our attention, we need to get ready or be prepared to be comfortable with some amount of a concentration risk in the portfolio. And as we speak, Paul brought to my attention there's a potential large deal the team is currently looking on, can be in orders, I want to say, could be in the orders of billions. And one of the questions, when Paul first talked to me, Paul asked me, will we be ready, with this kind of concentration risk? And I encouraged Paul and the team to look into it. The more we know, then the better we can answer the question: are we comfortable or not?
Okay, thank you.
And one point, if I may add, Ms. Middleton, is one of the strategic cornerstones of the real assets portfolio is that we hold the assets. They're meant to be held for a long period of time, and so it takes that extra layer of really thinking through the asset for the long term, knowing that our portfolio won't be churning much when we get it to where it needs to be.
Okay, thank you.
Thank you. Ms. Brown.
Hi, I want to piggyback on something Ms. Oliver has asked, or in your answer to her, Mr. Machaca, and that is you talked about the reason why we lagged the benchmarks in 1 and 3 years is one of the things was we had write-downs and valuations. And I sort of have a general question about that, and maybe this also goes to Mr. Ming, and that is, at what point is the board informed of those write-downs and valuations, whether it be in real estate or any other asset we hold, including private equity? When we have write-downs and valuation, when is the board informed, or is the board informed?
I would like to say the board is always informed every time we put up with a performance report, either bi-monthly, quarterly, or annual. So all the performance number, when we receive it, we share with the committee with no constraints or no holding back if that's what you were asking for. So the board is always informed.
And maybe I shouldn't say informed. If you give us a big table that shows the value of the asset, like in the CAFR, it shows the value of the asset now and the value of the asset later, but we don't know if that value has changed because maybe you sold something, or is it just a write-down? So I'm more curious or concerned about if we have a large write-down in a major asset, that the board be informed, whether it's an open or in closed session, that we know. I don't know what the dollar value is, but if it's a major write-down, we would like to know, like some property holding or something like that. That's my preference, that it be discussed, not just put in a table with thousands of other numbers.
I would think, as we move to the inside tools, I would think there will be ability for you electronically. You can sort by the amount of write-down. We can also think of other ways, depending on what's the right threshold the committee deems appropriate. We can highlight.
Yeah. And I'm not just talking about, like, say, if real estate drops 10%, and then, of course, it all drops, but I'm talking about things that are exceptions or concerns that the board, I would want to be made aware of. Thank you.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chairman. Yeah, piggybacking again on your response to Ms. Milton's question about the more detailed underwriting as causing, and maybe this is going to be addressed in the consultant's report, because Makita does talk about some threats to this asset class, such as downturn in the market growth, proliferation of new bank lenders, less regulation, higher leverage. Are these the type of additional underwriting provisions you're referring to, or should we just wait till Makita does this report?
Thank you, Mr. Jones. I think to talk further detail about our underwriting standards, we would need to do that in closed session.
Okay, thank you. I take the question back.
Thank you. Seeing no other request, anything else from you, Mr. Machaka, on this item?
No, thank you.
All right. Before we go to the consultants, I do have a request from the public. Al Darby, please come forward. The microphone will be turned on for you. You have up to 3 minutes to make your comments.
Good morning, Al Darby, President, RPEA. I want to preface my remarks this morning with the statement that this is above my pay grade, so I've asked a consultant, an expert consultant, to give us some help on this subject. That person, of course, is J.J. Jelensik, the only consultant that's available to us who served on this board for 20 years and has intimate knowledge of all of these policies. With that, I want to say that the real assets program, within the program being presented, it appears that there's a relocation of limits to PRP. In other words, more staff responsibility and no board review is required. The second substantive change is a proposed deletion of leverage limits from the RA program policy, which were previously relocated to newly created leverage policy-related procedures, PRP, to align with the recently approved changes centralizing leverage management for the public asset class in the total fund level and relocating program-specific constraints to PRP. The same change is true for PE. This language is being removed. This moves leverage out of the policy of board control, and PRP will take over. So this proposal suggests that no more oversight of the board in the matter of leverage. Thank you.
Thank you. Next is the board consultants review, 9B.
Good morning. Christy Fields, Makita Investment Group. I'd like to first thank the committee for retaining us to be a real estate consultant going forward. Thank you very much. It's been our pleasure and honor to be a real estate consultant for the last 10 years. It's also nice to be here presenting the annual program review, which we have been doing for the last 10 years. It's gotten progressively easier story to tell, and that's a credit to Paul and his team and all the work that they have done and continue to do. David and I are going to focus our comments primarily on the SWOT section of the letter that we prepared. And then we'll take questions after that. But as Paul mentioned, the portfolio is accomplishing what it is set out to do, providing current income with which you can pay your beneficiaries, important diversification against your growth and equity risk, and protection against inflation. Amongst the strengths that we've highlighted, I'd like to call out particularly the long-term strategy, which is increasingly well integrated with the overall strategic direction of the fund. there is increasing congruency between what the real assets program is delivering to the fund through the underlying portfolio composition. I'd also like to call out the diversity of the group, of the investment team, and the strong leadership. Paul's been here almost 5 years now, and he provides a very measured, intellectually honest, and disciplined approach to investing. He's a strong mentor to his team, and he's provided really good research discipline. The improvement in the research produced by the group has been truly impressive over the last few years, and I think that informs the performance of the real estate portfolio. The last of the strengths I'll call out at this point is the scale. You all have this in spades, and it serves the real assets portfolio in particular because of the business model that it allows, which is these large, fee-efficient, scalable separate accounts. David?
Thank you, David Glickman.
Microphone. Thank you.
Thank you, David Glickman, Makita Investment Group. I'm going to spend one more minute on a strength, which, riffing off of Ben's 4 Ps, I'm going to call the 4 Cs, which aren't about buying diamonds today, but rather are collegiality, cooperation, cohesiveness, and consistency. One of the goals of the annual program review is to report what has happened, and another goal, at least from our point of view, is to try to look forward. And there will be a downturn in real estate performance coming forward. We're not sure when or how much, but there will be one. And an asset that you have that isn't reflected on your balance sheet, but which is an important asset that will serve you well in those times, is your staff. And the fact that they have been together and are consistent in their approach in executing your beliefs and your policies will give you protection when the downturn comes. That's not so easily visible right now, but we think looking forward, it's useful for you to know. Turning to some of the things that are challenges and weaknesses, no offense, Christy, but scale's one of those too. The ability to be nimble in specific real estate transactions is not part of your everyday program, since the dollar amounts that you need to invest to be effective are not small amounts. And there are lots of competition for the properties that you seek. So in that case, scale works a little bit against you. You are a first call when deals of size come to market, and that's an advantage. But the ability to do lots of deals fast is not something that is part of this program. Let me talk about another more general weakness, which was alluded to in some of the comments from the board members about the infrastructure implementation. Similarly, in real estate, there are an awful lot of investors who are chasing the same deals that you are. And to staff's credit, they have maintained the discipline around their return hurdles and not chased deals. And we've noticed that for every year that we've come to report to you for the last 7 years. And we think that that's a strength. There are 2 markets at which to look. One is the space markets of the individual real estate properties, which are pretty close to equilibrium. The difference between the demand for space and the supply of new space being created is at a pretty reasonable comparison point. But the other market, which is capital markets, there are imbalances. There is more capital chasing transactions than there are transactions of merit. And so that's going to affect the deployment and the pacing to some degree. And over the long term, that should settle, but in the shorter term, that may be an area of some difficulty.
With respect to opportunities, I think CalPERS sits in a really interesting space in the middle, in the nexus of some of these that we've highlighted here, including the changing way that people are interacting with their built environment, sustainability efforts, and data analytics in portfolio management. You have a very large, diversified portfolio, and so you have, in essence, a terrific beta lab for understanding how all of these dynamic forces will interact to impact real estate. And your business model allows you to be pretty close to your real estate through these separate account relationships, and to have the governance needed to be able to kind of peer around the next corner and understand how your real estate portfolio is going to be impacted by some of these dynamics. So I think there's a lot of opportunity here ahead of you for CalPERS real estate.
And last, we'll talk about a couple of threats. Not all threats come true, but prudence suggests that you prepare for them in any event. The one that gets most of the headlines right now is changes in space use, or what's referred to as disruption. And this is an area that you are exposed to. You are less exposed than some other real estate investors, in part because you retain good control and governance over your assets. You can make changes directly if you find that that's important. And you are less exposed than some other investors because the quality of your portfolio, the locations, the assets that you own is of high quality, and therefore will continue to be attractive to the largest percentage of prospective users. At the same time, as was described in the write-down of the retail properties, people are changing how they use their real estate. Your property managers, your outside investment managers, have low enough leverage in the separate accounts and access to capital, so they will be able to respond and hopefully anticipate some of these changes in what we think is a protective way, compared to some other real estate owners who are leveraged too high or don't have access to additional capital to keep making the improvements and changing the character of the properties to continue to attract tenants and consumers. The things that we watch closely are new supply that isn't already leased, so spec building, and the willingness of construction lenders to advance higher and higher percentages of the cost of new construction. So far, those two areas are moderate, and we don't see an excess of new speculative building in most markets, in most property types domestically. At the same time, as new lenders come into the arena, as banks have restrictions lifted from them and they begin to look at construction lending as a highly margined part of their business model, you have to be careful that markets don't get ahead of themselves in delivering new supply. With that, we will ask the committee if they have any questions for us, which we would like to try to answer. Thank you.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chair. Thank you for the presentation and recognizing that our real assets is a long-term opportunity that we're looking at 40, 50 years out in the future. I was at a meeting last week, and there was an observation of AI implications in hotel, where it was all face recognition. There was, you check in, you order food, you turn on the lights, everything was done through an AI component. So I wanted to get your views on where do you see the AI, what do you see the implications of our going forward in real estate infrastructure in terms of AI's impact on our portfolio going forward?
Well, I'll try. Not being an expert on AI. It is said that real estate specifically has been a little bit late to the party in terms of modernizing the interface between the customer and the landlord. And so there is a lot of attention in an area that's called prop tech, where the disciplines of technology and real assets are trying to be merged. In order to be effective, it's going to require capital, and there will be false starts. But I think in general, your managers are well positioned because the balance sheets of the individual real estate partnerships that you've created have capacity to make incremental investments not only in new physical space but in technological advances as well. We know, for example, that the shopping center, the regional mall owners with whom you are partners are spending tens of millions of dollars a year to try to continue to make those malls attractive for people to show up and to integrate point of sales in the malls with point of sales on the internet. And so we follow those trends, and we think that as the best and the brightest ideas emerge, which will cost money, your managers are going to be able to deploy them and implement them in your properties.
If I may add, thank you, David. One of the disciplines that we have in our business model is what we call the AIP, or Annual Investment Plan. It has two of your letters, but it doesn't mean artificial intelligence. But the Annual Investment Plan, where each of our separate account relationships come and meet with all of our staff to propose their plan for the next year. In this discipline, we are talking about the exact trends within each of these specific area, whether it be retail or office or apartment, so that we can evolve our portfolio either through the sale of properties we don't believe will be positioned well for the future, or reinvesting in properties that we believe maybe just need some reinvestment, or reaffirming the properties that we believe should stay, and lastly, investing in new properties for the future. So that discipline of us having these annual plans come through our shop within Real Assets really give us the ability to evolve the portfolio in a very disciplined way. And I always like to say, these trends, you never want to overreact, but you also don't want to underreact. And we try to find that balance of being very measured at the same time and consistent, but methodically adapting to a trend or a change.
Okay, thank you very much. Appreciate that.
Thank you. Ms. Taylor.
Yes, thank you. Thank you, Mr. Glickman. And Christy, I'm sorry. I had a couple of, actually, I had one question to start with. You mentioned earlier about space disruption. So what constitutes space disruption? New space disruption.
So the most visible example of space disruption is WeWork, where the traditional office model was supplemented by a communal office model. And there have been disruptions in industrial warehouse, where owning a distribution facility close to the last mile of delivery becomes much more critical than being located at the intersection of two interstates. The office and the industrial are supplemented by retail disruption, where you buy things from Amazon rather than going to the department store. So those are examples. The malls are another high-profile example of having dramatic changes in the use of the square footage, where the old department store is now a community college. So those would be some examples.
Okay, great. Thank you. I was also a little concerned in your threats outline of there's a proliferation of non-bank lenders and less regulation. I understand that our underwriting is much better than that, and that we're not getting involved in that. But and then higher leverage and speculative supply. And you did mention that, but what kind of impact is that going to have in the future, even though I suspect that we won't have any of those in our portfolio, but it may affect.
So here's how I think it might affect it. There's two ways. One is if new supply is delivered and not taken up, not leased ahead of time, then that's going to potentially depress market rents for that subsector. And when the evaluation of your assets occurs each quarter and each year, the lower growth rate for rents over the next projected period is going to diminish the value of your existing asset. The second way that it's going to potentially hurt is if a lot of new space is delivered, then the competition for your tenants is going to increase. And the new empty space is going to try to make a deal to take your tenants and fill up their buildings. So the prospect of new supply being created speculatively is something that might indirectly affect your assets when the leases in your assets roll to mature and have to be released.
Doesn't that, I guess when I think about that, though, don't we have a shortage of office space and retail, well, not retail space, but office space in general in the bigger cities right now? So I don't, I'm not speaking
So
just in
your
Sacramento.
portfolio is very well occupied. Your commercial assets, not counting apartments, but are somewhere north of 90%, and the average lease term on the office leases and the other retail and industrial leases is somewhere around 6 years on average. Apartments, of course, are leased either for 6 months or a year, so that's a little different. You are somewhat insulated. Different submarkets have different supply and demand characteristics, so that the vacancy rates in some submarkets are troubling. There have been a lot of new apartments created in Phoenix, Arizona over the last years, and so rental growth in Phoenix apartments hasn't been terrific for the last couple of years. That will subside over time, but there is the possibility that the new supply will make it difficult. Most markets are close to equilibrium. Nationally, office vacancy is at a relatively low rate from a historic basis. Retail has problems. Apartments are at a high occupancy rate, low vacancy rate, and industrial seems to be at the lowest vacancy rate right now. So it's not a threat right now, but opening the spigots to new construction could change those dynamics over a 24 or 36-month period.
Okay. Ms. Fields, did you have, it looked like, okay. Thank you.
Thank you. Ms. Oliveris.
Thank you for this presentation. I had a couple questions under the section diversification along key parameters and some of the allocation there. In particular, for the real asset segments, we have some policy ranges and limits and then our exposure. And I noticed that essential, specialized, and international seem to be out of range.
Oh, sorry. Excuse me. The ranges are 0 to then the upper band limit. Am I misunderstanding the question?
Yes.
So essential is 0 to 25 and has a exposure of 0. Residential is 0 to 40 and has an exposure of 23.6. Is that what we're looking at?
Attachment 2, page 6 of 9.
6. Oh, I think that's infrastructure.
Okay,
Sorry, they're up next.
thanks.
Anything else, Ms. Oliveris?
No, thank you.
All right. Seeing no other requests?
Thank you.
Thank you.
Anything else? All right. Before we go on to item 9C, I just want to state that Mr. Darby, I believe the person that was sharing information with you, that information was for the previous agenda item, for 8A, not 9A. So now that we've digested what you had to say, I believe that's where that was coming from. All right, now we move on to item 9. So I don't know if that changes your request to speak under 9C, so you just might want to consider that. Thank you. All right, 9C, the private equity. Excuse me?
Sorry, Mr. Chair, for 9B, we still have the infrastructure
very good.
consultant
Sorry,
reviews.
yes.
Makita will cover infrastructure, and then we'll move on to 9C.
I'd be confused since one was sitting over here didn't say anything. Like, what are we doing here?
We'll be quick.
No hurry.
Steve McCourt, Makita Investment Group. Our report is fairly brief. I'll make a couple of summary comments and then hand it over to Lisa for a handful of observations. And of course, welcome any questions from the committee as well. Three comments I'd like to make. First of all, as was reported by staff and commented on already performance has been exceedingly strong for your infrastructure assets. Over the prior 10-year period, the annualized return is 17.9%. That, of course, is your average return each year over those 10 years. I wanted to highlight the power of compounding in the sense that what that means for you is that every dollar you had invested in infrastructure 10 years ago turned into $5.70. Every $1 billion turns into $5.7 billion. So this has been a very strong asset class for you. The challenge that's been highlighted is trying to get more dollars into this asset class given the competition for it. Your program is in compliance with all policy parameters, and we believe it's fully aligned with all of your investment beliefs. With that, I'll hand it over to Lisa for a few additional comments.
Good morning, Lisa Bacon, Makita Investment Group. I'll walk through a couple of the comments that we made, and they're consistent and echo the comments that Paul made in his report, and also some of the comments my colleagues made around the real estate portfolio. Starting with performance, as Steve mentioned and others have, it's stellar, impressive. I wouldn't, and we've guided that I wouldn't expect it to continue at these levels. Some of your experience in the infrastructure program has been unique, and I would expect that to moderate some. Part of the marks right here are benefiting from a very competitive core marketplace, which is the same market that you all are wanting to deploy money into. And so that goes to the comments also that have been made around the team's careful underwriting and discipline, which we've had occasion to observe really over the last 4 to 5 years as a board consultant and then as a regular consultant. And so we can attest to the truth in that. With respect to the growth of the portfolio, that also has been impressive, perhaps a little slower than you or staff may have liked, but I think appropriate for the asset class and the kinds of accounts and governance structures that you all are seeking. It's fairly easy to make commitments to commingled funds and get capital drawn. It is harder to develop strategic relationships with best-in-class partners, to negotiate separate accounts with the kinds of favorable governance that an institution like CalPERS can command, and then to have those managers in turn also be disciplined in the marketplace in getting the kinds of assets that you all are seeking. We've noted before the tremendous growth from even 10 years ago when the program started out at about $700 million to almost $7.5 million now, when you think about what you've got committed that hasn't been drawn and what you've got that's invested. With respect to the net asset value, as Paul mentioned, it's almost $5 billion. He's had charts that show you the growth in that over the last couple years of $1 billion a year. That's really a tremendous accomplishment in terms of getting that kind of capital out with the kinds of discipline and in the diverse amount of assets in various sectors and in various geographies to create a well-diversified portfolio. I'll also want to comment on the managers and the investment structures, again echoing Paul's comments that somewhat following the real estate model, but modifying it for the realities of the infrastructure space. The investment program is seeking to primarily deploy capital through separate accounts. In infrastructure, in some respects, that I would argue is more challenging than in real estate because the assets are so large. It is much harder to go and get multiple infrastructure assets with a single manager in the kind of volume and capital deployment that I've seen be successful in the real estate space. The kinds of assets that CalPERS is looking for are multi-billion-dollar assets usually. Some of them are more in the middle market, several $100 million, but they're all highly competed, and so it takes CalPERS relationships with these managers, with the sellers, as a partner that can transact and a partner that is interested in a long-term hold. Paul also mentioned some of the accomplishments this year with respect to some new separate accounts, some expanded separate accounts, and some strategic commitments to commingled funds that will provide certain access to certain kinds of investments. We've had the opportunity to watch staff develop this strategy and tailor it for the infrastructure program over the last couple years. I know it's been frustrating for some of you all and for them in the time it's taken to accomplish this, but I can tell you that the outcome is very impressive with respect to the accounts they have, the governance they have, and the managers that they're going to be able to move forward with. And so we have very positive views about the team being able to continue to deploy the amount of capital they're seeking to deploy in the space with best-in-class managers. I think I'll conclude my remarks with that and answer your questions.
Thank you. Seeing no other requests, did you want to ask your question again, Ms. Olivers? Push your buttons.
This before it's some
Mr.
forum.
Rubalcaba.
Thank you, Mr. Chair. I think I've asked this before, and I can't remember where. And I need refresher. What is a club, a consortium vehicle?
So the term club generally refers to a sort of an invitation-only commingled fund, if you will. So generally, it's anywhere from 2 to 4, usually large pension plans that have similar goals and objectives and similar longer-term hold, and so they negotiate this invitation-only account with a general partner. So it looks similar to a commingled fund, but there are fewer members. They have more, many more governance rights than typically they would have in a typical commingled fund. So it's not exactly the one-to-one alignment or relationship of a separate account, but a lot of managers are either want to expand their separate account business, or they're potentially leery of having an account with just one LP. Having a club also gives the manager more capital, for example, and more dependable capital. It also helps the LPs participating in that, the ability to maybe not deploy such a big chunk into a single asset, but take maybe a smaller piece, but still have the kind of governance that they're looking for.
Thank you. Thank you, Mr. Chair.
Thank you. Ms. Oliveros.
Thank you. So sorry. I'm
Page
gonna ask
6
the
of
question
9?
now. Yeah. Page 6.
So on this table, with respect to the real asset segments, these segments are judged for compliance at the real asset program level, and so they are not judged for compliance at the infrastructure portfolio level. And so we put these here just really for informational purposes, and since infrastructure is a relatively smaller portion of the whole real asset program compared to the $30-some billion that real estate has, the weights in infrastructure don't influence the overall numbers that much. But as the infrastructure program grows, it's just something that we look at just to see what the relationship is. And at least right now, there's no sort of positive or negative judgment around the numbers.
I'm sorry, I'm trying to understand. So we have policy ranges in place, right?
Yes.
But we're outside of those policy ranges.
So the policy ranges are applied at the real asset program level and not at the infrastructure portfolio level. So these are informational only, and they're not.
And why aren't they not applied at the infrastructure level?
They don't have to comply.
So we are in compliance. I want to start with that. We are in compliance with the with the limits in the policy guideline, given that this is measured at the real assets level. So I don't have the table committed to memory, but across our separate segment limits or ranges, all of them are within compliance today. It's just, I believe what Makita did was just only look at within the infrastructure portfolio and not across the program. The other point I want to make is, in terms of policy, the infrastructure policy limits kick in once it gets over $5 billion, which we will be in that position next year, or this year, I should say, this fiscal year, because once you're below 5 billion, you might do one deal, a few hundred million. It can move the needle so dramatically that at 5 billion, there's enough of a denominator for us to now measure the policy limits. So in this fiscal year, we will have breached the $5 billion floor, and all the policy within infrastructure will kick in.
So going back to the ranges that are indicated here, so 0 to 25 for essential, and we're at 32, 0 to 40 for residential, 0 to 20 for specialized, we're at 27, international 0 to 25, we're at 29.4. You're saying those policy ranges do not apply because this is for infrastructure in particular. And if there was a policy range for infrastructure, it wouldn't apply until it's at 5 billion or more?
5 billion. So I'll give you the actual figures for essential. So the 0 to 25% permissible range for essential, we're actually at 6% when you do the across real assets. So we're within the range. And then I believe the other one you mentioned was international?
So is essential, specialized, international. So I get there's real assets versus international, but I still want to understand why we have these policy ranges in place for infrastructure. What's the thinking behind that? And then why do we have this change at the $5 billion mark?
So the ranges that you see are simply for real assets. They are not for infrastructure, if I'm understanding.
So we don't have a policy range for infrastructure.
We don't have a specific range for these segments because the segments apply to the whole portfolio. There are some segments that include two different, technically include real estate and infrastructure together. So take something like commercial. Commercial would include an office building, industrial, and let's say a toll road. So they all kind of merge together in order for us to manage the real assets pool. The second point I made was just the fact that any specific policy limit related to only infrastructure is enforced once we get above a $5 billion net asset value. In order for us to build the portfolio up until that point, there could be a lot of movement. And so therefore, we, with the board, put together that floor in order for us to build the portfolio up until 5 billion.
So what are the policy limits once the $5 billion trigger has been met?
The policy would only apply to things like...
Yeah, so the rest of that table applies. So if you look at that table, the footnote under the real asset segment sort of highlights that's for informational purposes only because those policy limits are at the real assets level. We're just providing that those allocations for information. The rest of the parameters that are mentioned there, the risk classification, geographic region, and leverage are applicable to the infrastructure program, and the program's in compliance today with all of those, even though what Paul had mentioned, technically it doesn't have to be because it's not quite at $5 billion yet.
Yeah, and to answer your question, Ms. Olivares, the reason we need $5 billion is no magic about $5 billion. We need a sizable portfolio. As I mentioned, that particularly for infrastructure investment, the size tends to be lumpy. Right? When you have a big deal coming in, if your denominator, the size of the overall portfolio is so small, the denominator is so small, when you have a new deal comes in, can easily move you the constraints or the policy range from one way to another. So that's why we need to build a large enough portfolio before we can apply any meaningful constraints or policy to that segment of the portfolio.
Thank you. Yeah, I understand that. So after that 5 billion trigger has been met, then what do any policy range limitations apply to infrastructure when it comes to essential, specialized, and international, or no?
The only areas the policy covers are risk classification, so that would be the core, value add, or opportunistic. Geography being the United States, developed markets, or emerging markets. And then there are leverage limits around debt service coverage ratio and loan to value. All of those items would be covered within the infrastructure portfolio.
Okay, so no infrastructure segment policy ranges apply.
Correct.
Thank you.
Sorry about that.
It's fine.
All right, very good. Thank you. Anything else? Great. All
And
right.
Mr. Fechner, I misspoke. Next goes Wilshire,
Got it.
and then we move on to private equity. Thank you,
I
sir.
wonder why he was sitting there, so.
I've wondered that myself. Andrew Junkin with Wilshire Consulting. Good morning. At the risk of gilding the lily, I have a few comments, but I will keep them short. So I'm going to wear two hats. One is the general pension consultant, and then one is the forest land consultant. As the general consultant, the most important part of this review to us is that the real asset class is playing the role it was designed to protect against inflation and to hedge against equity risk. So it's doing both of those. We make some comments specific to that in our letter. I won't rehash those here. When it comes to forest land, I think I was here when the investment was made in Crown Pine. So there was some question about, or a comment that Paul made about that. And at the time, and goodness, this was, what was the 2007, so 12 years ago, there was an expectation that forest land was going to be a big part of the CalPERS portfolio going forward, like moving up to 5 or 10% of the program. In some ways, that was sort of mimicking some of the things that the Ivy League endowments had done. So the Crown Pine investment was looked at as kind of a big step forward towards that goal. But the market changed with the global financial crisis. If you can believe it, it actually became less liquid, an illiquid market becoming less liquid. And sales went from some sizable chunks to very small chunks. So CalPERS never really was able to build a fully diversified portfolio. It's hard to estimate the size of the institutional forest land market, but one of the recent estimates is it's a couple $100 billion. So if you think of CalPERS at 10%, you'd be almost 20% of that market. That just doesn't work in an illiquid market. So timber, broadly, your portfolio obviously hasn't done as well as the other segments of real assets. CalPERS had some very specific issues with Crown Pine, which are now gone. The issue of leverage, some forced sales there. It was very concentrated. The remaining assets, as Paul mentioned, are better. There's no rush to fire sale them. They have to compete against the rest of the real asset portfolio. There is now no longer a forest land benchmark. There is simply a real assets benchmark. And if you find additional forest land that fits well within that portfolio, then you could consider it. There's none being considered at the moment, but there's certainly no rush to get rid of the assets that you have at the moment. I do want to spend just 1 second here, and I think everybody's touched on it, in particular as it comes to building up the infrastructure portfolio. And why aren't we moving more quickly? And I think that's a great question, but I think actually forest land is a pretty good example of why you want to be careful. So there was a lot of concentration risk trying to move that portfolio forward quickly, and we can see what happened, with the benefit of hindsight. Infrastructure admittedly has been slow growing. It is also an illiquid, hard to transact market. Pricing and pacing is an issue. If you look at the broad private markets, we've seen such a seismic shift for investors over the past 10 or 15 years. There is now $2.6 trillion of dry powder with a T. Of that, $1.5 billion is private equity, and I know they're coming up next, and I know that pacing there is an issue. So keep that in mind. And that $2.6 trillion is up about 30% in the last 3 years. Money is just pouring into private asset classes. So real estate, there's dry powder of about $400 billion. And infrastructure, there's dry powder of about $250 billion. So to the points that have been made about sort of accelerating the growth in the infrastructure market or moving the weights forward, it's tough. It's tough to compete. There are a lot of people chasing those assets. And I think that using forest land as an example, you can see the benefit of the discipline that staff has had in the infrastructure market.
All right.
Happy to stop there.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, Mr. Johnson, yeah, just, but on the point about the slow growth in infrastructure to take from lessons learned with the timberland, timber issues, but those are really two very different industries. The forest is a very small piece of the economy. The infrastructure is the total economy. So you may not want to use the same lessons learned from timber to use for such a large potential asset class. It's just an observation.
I completely agree. Really, my point was about the concentration of trying to build a portfolio when you have to take a bigger bite of something to kind of move the portfolio forward. And it can work out really, really well, as I think some of your first infrastructure investments did. And they because you had zero to start with, your first few were significant pieces as a percentage, and they did spectacularly well.
Right.
I'm using forest land as the countervailing example to that.
All right. Anything else, Mr. Jones? Okay, seeing nothing else, thank you very much. Brings us to item 9C, private equity. Mr. Meng.
Yes, Mr. Chair. So again, this is the annual program review of the second private asset class, which is private equity. So with that, I'll turn over to my colleague, Greg Ruiz, and also together with the consultants.
Good morning.
Good morning.
Before I dive into my presentation, I wanted to start with an overall assessment of the program. I believe the core of our private equity program is stable and healthy. We have strong relationships with high-quality managers, and maintaining, cultivating, and expanding those relationships is going to be fundamental to the success of the program. The private equity industry is dynamic and changing, and there are opportunities for us to continue to evolve our private equity strategy. It's important that we do so. A thoughtful and cautious evolution to our program will better position us to leverage our core capabilities, achieve our targeted rate of return, while deploying additional capital into the asset class. As we move to the presentation itself, I'd like to start with our portfolio. The objective of our private equity portfolio is to enhance the equity returns of the fund. Our allocation to and returns from private equity today are the result of decisions made over the past 5 and even 10 years. Likewise, the decisions we are making today will not be fully experienced in the portfolio for 5 or 10 years to come. With such a long-dated asset class, it's incredibly important that we have consistency and a long-term commitment through all market environments. We have a very talented team with significant experience in private equity. Under the leadership of Sarah Core, over the past 2 years, the team has shown resilience in the face of significant uncertainty about the direction of the program. This has been no easy feat, and I'm incredibly proud of the work the team has done to maintain CalPERS' position in the industry while developing an inclusive and collaborative culture. When we look at our performance, there are 3 methods we use. We look at our performance relative to a benchmark, relative to our asset liability management assumptions, and relative to other asset classes, in particular global equity. I'll go into additional detail later in the presentation on, on our performance, but at a high level, we've outperformed our benchmark over the 20 and 1-year time horizons, and we've underperformed our benchmark over the 3, 5, and 10-year time horizons. Relative to our ALM assumptions and other asset classes, we've outperformed for nearly all time periods. We had a number of accomplishments over the last fiscal year, including scaling our capital commitments to nearly $7 billion. This represents a significant step up over the prior year, and we're on track to exceed that amount this year. We've evolved our team structure by integrating underwriting and monitoring. We've also continued to improve our culture. We also have assessed new methods for capital deployment, including co-investment, as well as partnering with teams to gain exposure to areas we miss in our current relationships. We also have a number of major initiatives on our plate for this fiscal year. As part of my early assessment, we will initiate a strategic planning process to frame our long-term objectives. We participate in a rapidly changing industry, and we've seen our peers evolve in some ways where we've yet to commit ourselves. We will build on the important work that's been done over the past few years, take stock of where we are, and assess how we can position ourselves for success for 5 and 10 years to come. You'll see us continue to focus on our core capabilities, which are effective underwriting and engaged monitoring, and we will also assess how we can expand our investment capabilities. Co-investment is going to be an important element of our strategy moving forward, and it's an area where I expect we'll make progress this year. It will also be an area where we need to assess our resources. We'll need to look at what we need to execute the strategy, and we may need to expand our capabilities with additional resources. We will also continue to integrate ESG factors into our investment processes in areas where we've made significant headway over the past few years. On this slide, we lay out performance. Once again, there are the 3 relevant comparisons I noted earlier. Compared to benchmark, you'll see we outperformed our benchmark over the 20 and 1-year time horizon. We've underperformed over the 3, 5, and 10-year time horizon. Relative to our ALM assumptions, we've outperformed over all time horizons, with the exception of the 1 year. And relative to the global equity benchmark, we've outperformed over all time periods. Overall, I believe we have a strong core private equity portfolio. When we assess our historical performance, we've been most successful when we stick firmly to our core, and we've underperformed when we've strayed too far from our core. So on a go-forward basis, we will remain focused and expand only into those areas where we have high conviction we can leverage our core capabilities to drive durable outperformance. Thank you.
Thank you. Ms. Brown.
Thank you, Mr. Chair. Mr. Rees, I've asked this question before, probably not a view of Mr. Bagastan, but he explained it to me and I didn't understand the explanation. So maybe I can get you to put it in plain English. When I look at page 6 of 23, the one we were just looking at, the PE policy benchmark, and I don't understand why it's only 4% for last year.
Sure.
Ben, you want to take it?
Yeah, I'm happy to jump in. So
Okay.
the way our benchmark works is it's set basically on a public equity index, and then there's an additional amount above that. So until recently, it was plus 300 basis points. Now it's plus 150 basis points. So the benchmark is just going to be a reflection of the underlying public index plus now 150 basis points. So it will fluctuate each year. And years where the public markets perform very well, it will be high. And years when they perform less well, it will be lower.
In addition to the spread on top of the public equity market returns, there's also a 1-quarter delay. So our because of the appraisal process,
Right.
so it's 1 quarter lagged public equity plus 150.
Yeah, the benchmark just seems so low, like I could stagger over that bar.
But please be mindful that we are trying. This is a long-dated asset class. We're focusing on long-term. So the year-by-year return, public market, given the volatility of the public markets. So we expect to see this kind of volatility in the benchmark.
Okay, thank you.
Thank you. Ms. G.
Thank you, Mr. Chairman. I wanted to just take a look at slide 23 and understand a little bit better why the fees were substantially higher this fiscal year when the assets under management dropped by about $700 million.
Yeah, so there's really two components of the fees that are lumped in. If you look at the external management,
right,
there's two components of the fee. One is the management fees we pay on our assets, and the other is performance fees. The way the performance fees work are our managers will take a share of the profits above a preferred return.
Right.
When there is a strong selling environment and we're receiving a lot of distributions, they will receive a share of those profits. So while overall fees went up, the vast majority of that is driven by the performance fees, which means we also receive very significant distributions.
You see, so this is the rare place that we're happy to pay a higher fee. Means that our manager have generated a higher return, and we want to see this. That is the alignment of interest. When we do well, we don't mind they do well.
Right. Okay. And I guess on the issue of alignment of interest, I wanted to just kind of get your sense of how much influence CalPERS really has on GPs with respect to ESG factors and on analysis of potential investment. So are policies integrated into the portfolio company operations? I guess where does that consideration get made?
So I would take a first step and then turn over to Greg and maybe even to Bess and Anne as well. In terms of our ESG integration in private equity, so I see a few layers. First, before we select a general partner, during the due diligence process, we ask them what they do, how do they do to incorporate into the ESG considerations. So that's a due diligence process. And then we also ask the the GPs, when they invest in portfolio companies, they take these factors into consideration. And at the same time, when we analyze the GP itself, for example, the governance, and we look at how GPs conduct themselves from the ESG lens as well. So there's a few layers before we select them, and then we work with them, then we encourage them to consider these factors in their underwriting. So that's your second question. Your first question, how influential or how much we can do impactful CalPERS can be in terms of advocating ESG considerations. We have to say that we are very proud of what we have done, but we have to recognize the reality as one investor, one public pension fund. Our voice is limited. But even given that constraints, we are very proud of what we have done in terms of advocating these considerations and engaging with companies. But we also have to be very mindful in terms of integration into our portfolio, and that's where we apply the highest standard, which is our fiduciary duty.
Right. Okay. So, and I appreciate that because I think it certainly at every level that we will be engaging even the earlier stages. That makes sense, and hopefully there'll be some opportunity to actually incorporate some of the good work that has been done, particularly carbon footprint data and the like. We have been a leader at CalPERS with respect to corporate board diversity on the public side, and I recently sent a letter requesting more information with respect to private equity managers and portfolio corporate board diversity. Just wanted to get a sense of are there opportunities for us to continue our leadership with respect to on the private side?
So on that note, there is an organization called ILPA. I want to say Institution of Limited Partner Association, and as a representative of the entire LP community, I think they can be the most effective.
Okay. I just want to be sure that we hopefully can take every opportunity to try to push those goals and look at what more can be done, and particularly since we're making such progress on the public side. Great. Thank you.
Thank you. Mr. Perez.
Mr. Rees, on slide 14 of 23, your first bullet there says maximize risk-adjusted rate of return and enhance the equity return to the total fund. Can you explain in English how we can maximize the risk-adjusted rate of return in private equity?
Yeah. So what that means is we're looking to back managers. So these are people who are investing in companies. We're looking to back managers who we think can durably add value through all cycles. So that's saying kind of regardless of how the broader market is performing, we want to back managers who we think have specialized skill sets that can add value beyond that. So the role of private equity in our portfolio is to partner with these groups and deploy capital to them in the hopes of generating returns that are above what we're seeing in any other asset class.
But how does the maximizing the risk-adjusted return?
Yeah, what we mean with the risk-adjusted piece is we always think about the risk when we're deploying capital. And you could chase high returns in any given place in the market, but if you're not thinking about the downside protection, you expose yourself to changes in the market environment where what once looked very attractive has become much less attractive. And so I think what you'll see in our underwriting process is we're constantly asking ourselves how managers think not only about the opportunities, but also the downsides. So there may be times where we do not engage with a manager who has very strong returns because we don't have the belief that at an underlying level, they're going to outperform across cycles. It's difficult work, but that's where we spend a lot of our time and diligence.
Thank you.
Thank you. Mr. Jones.
Yeah, thank you, Mr. Chair. Yeah, a couple of technical questions. If you could go to page 16 of 23. Yeah, the less than 1% target. Would that eventually go to zero? Because did we have a policy to change our strategy in venture capital allocations?
You know, it's a very good question, and I'd say with venture capital, it's an area where we're actively considering our approach. And as was mentioned in the earlier presentation, one thing that we always have to think about is how do we participate in a particular segment at scale. Our historical experience, as you see there, has not been particularly strong in the asset class. I think there are certainly arguments both ways, and it's an area where we're taking kind of a close look at how we want to position ourselves going forward.
Okay. But did the board take action to remove this asset strategy from the portfolio, or that's just the staff?
I do not think so. I don't think the board made a decision to remove venture capital from the portfolio. What you see tail end of a venture capital in the portfolio, less than 1%, I would call that almost like a legacy asset. It's left over from early days. And as Greg just mentioned that in the past, we were out of the VC, the market segment for a number of reasons. And now we are trying to find ways to get us back into the VC community and get venture capital investment back into our portfolio. But the fact that we have been out of the market for so long, there are some catch up to do.
And that was the basis for my question, because on our private equity model, we talked about going forward in venture capital, but I thought I remembered the board taking action on this specific strategy some years ago. So maybe I'm mistaken.
Maybe Sarah.
Okay.
Sarah.
And I'm just trying to make sure we're not having conflicting policies, and so that's the reason for the question.
Sarah Core, Investment Office staff. When these ranges were put in place back in 2012, I believe, it always was 1%. At that point in time, staff didn't believe we could deploy capital in venture capital in a meaningful amount. The average fund size for venture funds is smaller than our average commitment is, and so it's a really hard area for us to deploy capital given our scale.
Okay, so it was just your strategy decision, it wasn't a board decision. That's what I was trying to
The board approved the policy target of less than 1%.
Oh, okay. Less than 1%. Okay. All right, thank you. And then the other question is Ms. Brown's question about the 4% benchmark. I remember you gave us a tutorial on benchmarks. I think we spent almost an hour being oriented in benchmarks. And so that public equities plus 115 basis point, was that a policy decision and when we changed it?
Yeah, so that was part of the 2017 ALM process.
Okay, so there was a policy change. I just wanted to put that in the record. Okay, thank you.
Thank you. Ms. Brown.
Well, thank you. Let me piggyback on Mr. Jones, piggybacking on me. I want to go back to that same table, page 6 of 23, and go back to that PE policy benchmark of 4%. Have we calculated that to see what it would have been under the prior calculation, the old
so
number plus 300?
So that'll be 550. The previous one is public equity plus 300. So these are public equity.
It was really much more
150.
complicated than public equity plus 300. It was a bunch of things. That someone remind me of that. It was really complicated. Plus 300, the old benchmark.
No, just public equity. The compensation public equity benchmark has a different components. And now I believe it's MSCI all world all cap. So only one index plus 150. You were right. It used to be a combination for a few sub-index and plus 300.
So have we done that I'd be interested in knowing what that calculation was if we go back. It just looks like with the new benchmark, we've set it way too low. That's my only concern, that if we can really just, stumble over the benchmark, then it doesn't appear to work for me. But we'll find out, and we can also ask our consultant about that.
Anything else, Ms. Brown?
No, thank you.
All right. Mr. Murubakaba.
Thank you, Mr. Chair. I appreciate the continued focus, integration of ESG factors, and I appreciate the discussion about maximizing risk adjustment rate of returns. But one thing I just want to make sure we're conscious of, or want to speak, if you could speak to it, Mr. Reese, is something I didn't see is, speaking of risk, is human capital management. I know in private equity there's been a lot of literature about there's been negative consequences about layoffs, and thinking of the Toys R Us story and things like that. So I just want to make sure that that's something we're also focused in our moving forward.
Yeah, it is. When we assess managers, we assess them across many dimensions. But I'd say through it all, it's incredibly important to us that we partner with people of integrity. And so that's kind of first and foremost. And I'd say there are many complexities once you get into managing companies. And we try and pick partners who we think will navigate those as well as possible. Once we enter into a partnership, we are not in control. We're one voice, but we are an active voice, and we certainly try and use our influence with our managers to get to the best outcomes we can.
Thank you.
Thank you. Thank you, Mr. Seha.
Thank you, Mr. Chair. And thank you for the presentation, Mr. Rees, as well. Question about something you mentioned in your presentation about that the culture has improved. And it was on page 4, one of the bullet points is that you built a more effective and collaborative culture. And I don't want to infer anything negative about what the culture may have been, but maybe you can elaborate a little more on how you've improved it or what's been done.
Yeah, and much of the credit goes to the team and happened before I was here in this role. But I think what you've seen over time is movement towards kind of much better leveraging of our intellectual capital across the team, less siloing, more collaboration, more inclusion, more robust discussions. And I think all of that leads ultimately to better investment judgments and investment outcomes. So that's kind of those changes we've seen on the team, and I think have been clear positives.
And I think it's worth noting that, and Greg is spot on right, that this is something that we've seen within the private equity team. We've tried to drive within the entire investment office. That's been a real focus of Ben's, is all focused on the total fund and one team. And then even within the enterprise, we ourselves as one team trying to manage this large portfolio to pay benefits over a multi-generational time horizon. But it's all about one team and one fund.
Thank you.
Yeah, very good. Thank you. All right, seeing no other requests, anything else, Mr. Ruiz?
No.
Very good. Thank you. Wait, before you leave, we have one request from the audience. Mr. Darby, please come forward. Again, you'll have up to 3 minutes for your comments.
Mr. Chair, board members, Al Darby, RPEA president. Again, I preface my remarks that they were based on information from an expert consultant, someone who served on this board and was an investment officer at CalPERS for many years. The staff here is proposing to amend the definition of customized investment account in the CalPERS specific glossary of terms to provide staff with more flexibility in selecting partners for these specialized accounts. The current constraints are quite stringent. Distinct expertise in an industry, geographic region, investment style, along with demonstrated ability to provide top quarter returns. So softening these requirements would again be an abdication of board oversight in this whole private equity scheme of things. So again, board erosion of oversight is suggested by this proposal. Thank you.
Thank you. Item 9D, the consultant review of the private equity program.
Good morning. Steve Hart from Makita Investment Group. I'm joined by my colleague Steve McCourt here to discuss the 2019 program review, which we've included as item 9D in your package. So first, I wanted to thank you for your renewed confidence in Makita Investment Group as your private equity board consultant. Thank you very much. I just wanted to go through a couple of topics, not going through page by page here, and Steve will pick up on a couple as well. I think that some has been discussed already here, but the important aspect of deploying assets at scale for this program is quite important. The program has ramped up its deployment of capital as little as $3 billion a couple of years ago to now $7 billion and kind of rising from there. So in terms of dollars, it's been increasing. We've noticed also that the quality of the underwriting has remained strong as well, so we feel good about that. But in order to continue to deploy at scale, additional avenues of deployment need to be continued to be thought about. As been discussed, co-investments is one that is under active review now and is getting continued attention, and expect that's going to be implemented more specifically later on in this year or in 2020. Also, has also been discussed here, the reduction of siloing within CalPERS and the more emphasis on the one fund approach has allowed staff to think more broadly about opportunities that may be available and without having to consider should it belong in one area or another, the right groups with the right analytical capabilities and relationships can assess those opportunities. So we've been pleased that that's continuing and development area within CalPERS. And the activities have been a lot of work done by staff on the pillars 3 and 4, the Horizon and the innovation portfolios. That's not at front burner right now, certainly, but there was a lot of work that was done and continued thought process around that to see if that will make sense to move forward. Moving to the staffing, as Greg had mentioned, I think the staff have done a really good job at maintaining CalPERS' presence in the marketplace and increasing the pacing over the last couple of years. And that's been good to see. And obviously now with Greg established as the managing investment director subsequent to the end of the review period, but that's a definite plus and can be have the team more settled in the private equity area. I'll turn to Steve to talk about a couple of further topics.
Great, thank you. I'm going to address performance and portfolio implementation. As staff noted, at the end of the fiscal year, the private equity program was valued at $26.5 billion. That was a 3% decrease in NAV over the prior year. Much like the last 8 or 9 years, the net asset value declined not because returns were negative. We've gone through the positive returns, but you continue to get more cash back in your private equity program from general partners than you allocate to them. This year, that amount was about $2.7 billion received back from general partners. And since 2011, you've now received $34 billion in cash back from the program, in excess of contributions to the program on a net of fee basis. The performance of the program over time has been strong. For the trailing 10 years, the program has produced a return of 14% per year on average. Again, translating that into kind of a cumulative return number in the last decade. That turns every dollar in the private equity asset class into $3.7, or every $1 billion into $3.7 billion. It's been your strongest performing asset class over that time period and has outperformed your long-term expectations in private equity as well as the fund's actuarial assumed rate of return. As was noted, the current benchmark to private equity returned 4.4% for the current year, so your program outperformed that benchmark by 3.3%. And over the trailing 3, 5, and 10 years, your returns have approximated that benchmark. They've failed to achieve the legacy benchmarks that you've had in private equity over that time period. In terms of implementation, much like with infrastructure, as was noted, the challenge in private equity has been less about achieving great returns and more about how to achieve scale in the asset class in a very competitive, illiquid market environment. Greg mentioned some of the elements that staff is looking at to expand their ability to achieve higher levels of investment in private equity. We would highlight that co-investments we believe are going to be a strong area to continue to look at to allocate additional capital to the space in a much more LP-friendly fee way. And also expanding relationships beyond the core 30 relationships that you have in order to achieve the long-term pacing assumption required to achieve your long-term target investment allocation. The final thing I want to highlight is that the plan, the program is currently invested within all policy parameters, as noted on page 6 of our memorandum.
Final thing, as your board consultant, we remain very active with the staff in all aspects of the program. So all 18 of the investments that were completed in the fiscal year, we were involved in the policy compliance review. There were 34 investment committee review committee meetings that took place where those and other investments were discussed, and we participated in all those. And there were a number of policy changes and reviews that we conducted, and of course the semi-annual reports that we have been involved with. So we remain very enthusiastic about the private equity program and look forward to another good fiscal year. Happy to answer any questions.
Thank you. Ms. Yee.
Thank you, Mr. Chairman. So what I'm hearing is that we're comfortable with the ability to meet the $10 billion annual pacing goal, and given the focus on some of the other areas to improve to try to meet that, right?
So I'd say there's two aspects to it. The first aspect being the staff capability to actually review the investment opportunities. That is there. The other important aspect is, as of this moment, this fundraising environment, there is ability to actually deploy at that pace because there is a lot of managers raising that capital.
Right.
You know, a challenge might be in a different environment. Will there be $10 billion worth of available high-quality opportunities for CalPERS in situations where managers are not raising as much capital? And I think that's going to be it's going to be very helpful for the staff to have additional avenues and ways of deploying capital, having the co-investments, having the separate managed accounts, having these other avenues that they can pursue to be able to deploy that capital. But for the next year, they're turning away more capital opportunities than they are underwriting, for sure.
Okay, good. And then when the lists of the core GPs were reduced to the 30 a few years ago, just to focus on investing with quality GPs, and I was happy to see the discussion about really increasing that number, obviously with more penetration in the area of co-investments. I assume you believe that's prudent to do as well, but my real question is, are there best practices that will ensure that we are going to continue to invest with quality GPs going forward? As we
So
expand?
the underwriting process at CalPERS is very strong. I think that you can see both in this year's letter and prior year's letter, there were some new managers that became part of the portfolio. The CalPERS folks are and staff are certainly looking for new managers on an active basis and using their transition manager programs, emerging manager programs as some of the sources to find those opportunities. At this point, we feel that they are continuing to pursue those other managers, and that makes sense to do, and they have strong underwriting practices around that. Yeah.
Controller, I just wanted to jump in on that. While we are expanding the amount of managers we're looking at, I would just convey that the bar for becoming a new manager in our portfolio is incredibly high.
Yeah.
So first and foremost, we want to maintain incredibly high underwriting standards. We think there are more than 30 managers that reach that bar, but as we look at new opportunities, it's going to be a very small subsegment of those that actually become part of our portfolio.
Okay, that makes sense. And then to Makita, so do you have any ideas about what more staff could do to achieve the diversity in both GPs and portfolio company boards and management? I mean, are you seeing kind of activity outside of CalPERS that may be helpful?
I know that they include those sorts of aspects in their underwriting process and their due diligence, looking for that and noting that ESG is an important aspect of their underwriting process as staff has explained. There is some limitation as a limited partner in a fund about how one can, subsequent to the commitment of the capital, how one can direct the general partner. But there is a general movement within the private equity and private markets manager community in general that these are important aspects, and they're being taken care of and being addressed. Maybe not consistently across all managers, but it is an area of focus and importance for the general partners. And I think, as mentioned also, ILPA as a trade organization has made some, able to amplify the voice for a larger set of limited partners on these sorts of topics.
Great. Thank you. Thank you, Mr. Chairman.
All right, before I go on to Ms. Oliveira, I just want to ask if you can weigh in with your opinion or your view on our benchmarking and how difficult is that to achieve, and what are other funds doing?
So benchmarks are, a challenge. We've talked about it several times in here. I think that where where it is now, that the having the benchmark now focused on the next alternative asset class for these sorts of dollars to go into, being the public equity asset class, is the right one, because if you weren't going to do private equity, where would you try to get something similar? That would be the global private equity. The spread of 150 basis points, we do believe is appropriate as well, because it is a reflection of what is expected for that asset class for private equity to achieve in excess of the public equity markets. And by aligning the benchmark with the long-term asset class expectations, there's some internal logic around that we believe makes sense. Across different investors, different LPs that are participating in the asset class, the large majority have some sort of a public equity plus a spread approach. Some of them use different sets of public equities for that benchmark. Some have, in addition, what they call a peer index, which is a private equity related index. How is that asset class doing overall, and comparing how the performance of the private equity in the particular LP's portfolio is doing against the broad marketplace, and to try to see, essentially answering the question there, how much of the return stream that is available in private equity is the LP actually achieving. It's answering a little bit of a different question. So, but overall, for this purpose, in terms of should CalPERS allocate money to private equity or not, having a public equity plus a spread benchmark, I think, makes a lot of sense.
And I just want to add or emphasize one element of that, which is your private equity benchmark is aligned with your long-term asset allocation assumptions for the asset class and the global equity asset class. So to have a benchmark that differed from your asset allocation policy, as it did historically, does strike one as a little inconsistent from a policy perspective. And much like every asset class on the planet these days, return expectations are lower today than they were 5 years ago or 10 years ago. So the reduction in the premium is consistent with how other asset classes were treated in the asset allocation process.
Mr. Chair, if I may add on, this question came up a couple of times this morning on the private equity benchmark, and particularly the spread. It used to be 300, now it's 150. So I would like to highlight two caveats to that. For one, generally speaking, people believe the additional or the spread on top of public equity, we expect that from private equity, and that's really mainly to compensate for the illiquidity premium. Because compared to public equity, private equity is not liquid. So naturally, as an investor, we demand some premium to be paid for the illiquidity. So that illiquidity premium now is getting smaller and smaller, simply because since the global financial crisis of 2008, global central banks have been flooding the capital market with excess liquidity. And when you have so much liquidity available, naturally the price for liquidity will come down. So that's one reason for the narrower spread. And the other one, over the decades of experience, we realized that for our size to earn, we run $400 billion fund. To earn 7% return is much harder than $40 billion fund to earn 7% return. So naturally, the size of our private equity program is much larger than many of our peers. And for smaller program, they were able to deliver, generally speaking, higher return. But at our size, it's getting harder and harder. So that's additional caveat to why the spread is coming down. One is the illiquidity premium is coming down, and the other is our size is getting bigger and bigger.
Thank you. Thank all of you. Ms. Oliveros.
Thank you. This is helpful, and I too have questions about the benchmark again. So I'm looking at page 3 of the report, attachment 1 to page 3 of 8, and I see that the benchmarks are both footnoted, the current benchmark and the previous benchmark. It's footnote number 2. The current benchmark is a custom FTSE all-world, all-cap equity.
Yes.
What do we mean by custom with that? We're not just taking FTSE all world, all cap, the 1-year benchmark, and adding 150 basis points with a quarter lag?
So, Ms. Oliveros, it's the global equity benchmark, as we've discussed. It's the idea of taking what we can get in the public markets relative to the privates Our public markets benchmark is a custom benchmark, customized for the capitalization levels it goes into, what countries it includes, all of those kinds of things. So it's not the off-the-shelf FTSE, it's the customized version of the FTSE. One of our other customizations is ex-tobacco and some of the other topics that are in there.
So if I look at the 1 year FTSE All World All Cap, it's 11.92 for 1 year.
So part of what's causing some discussion, maybe not confusion, but is something we call endpoint issues. So this return that we have for the FTSE All World of 4.4 is based upon, it's a March to March performance.
Sure.
And if you recall, there was that period in December where that return had been substantially decreased and then came back. If you looked at a different set of 12 months, so June to June, it'll come up with a different number.
Mm-hmm. I'm looking at March 31st, 2019 report, so it's a year over. And then I just looked at an October report, and I looked at MSCI, I've looked at Cambridge. So I've looked at 3 different benchmarks, right? So there's FTSE, there's MSCI,
Yep.
All World All Cap, that 1 year is 12.58. Cambridge uses Wilshire 5000 plus, that's in the 12 range too. So I'm really trying to understand, and this is just like public equities, right? That doesn't include the illiquidity premium. I don't know how we get from a range of around 12, which should be plus 150 or 300 for illiquidity, to 4.
Yeah, I think we'll have to go and look at the data. According to this, the FTSE, the custom FTSE benchmark was up 2.9%.
You're saying custom. So is there like some type of discount factor that we're using?
No, it's just customized for some of the specific constraints and exposures that your global equity policy has. But the custom benchmark shouldn't differ materially from the off-the-shelf benchmark. It's going to be very, very close.
So you mentioned the constraints. So it's customized for the constraints. But when we're talking about customization, are we talking about a discount factor that's being applied?
No.
No. Okay.
So, Ms. Oliveros, I think we'd have to see your data. What this is saying is that the FTSE All World, without the constraints, from March 31st of 2018 to March 31st of 2019, earned 4.4%. I'm sorry, earned 2.9% would be what the global equity benchmark earned. Our customizations caused it to earn 2.5%, and that's why the FTSE All World plus 150 was 4.4. And the FTSE, or the CalPERS custom benchmark, was 4%. That's 150 basis points in excess of what the public markets earn.
Yes, I want to make sure we're comparing apples and apples, because when I pull up the 1 year, I'm getting a different number. And same for MSCI.
Yep, so just one other thing here. On that custom policy benchmark, that 4% is actually composed of 3/4 of the FTSE plus the 150 and 1/4 of the old policy benchmark, which was a mix of two FTSE benchmarks, right? So there might be a little bit of a difference. So if you look in the second line of the second bullet point, the previous benchmark blend of FTSE US plus FTSE All World ex-US plus 3%. So there was 1/4 for this particular time period. There's 1/4 that was of that previous benchmark and 3/4 of this FTSE All World All Cap. So I believe that the 40 basis point difference between the FTSE All World 150 and the policy benchmark is likely explained by that.
I want to make sure I'm understanding. So again, in the second footnote, I see that the current policy benchmark is a custom FTSE All World All Cap plus 150 basis points, lagged by 1/4. But the previous benchmark was a blend of FTSE US plus FTSE All World ex-US plus 3%, lagged 1/4 from September 2011 to June 2018.
Correct.
So that's what you're talking about. So there's a part of it that overlaps.
There is one quarter that was overlap for that. So there's 3/4 of the new one, 1/4 of the old one.
Thank you. I believe it was in our last meeting where we talked about the illiquidity premium, right? And I understand that other pension funds have an illiquidity premium of 300 basis points, sometimes up to 500. I'm trying to understand why we're at 150.
So there are a couple things. So we had talked about looking to align the capital market assumptions with the benchmarking process. And the capital market assumption has for a long time period expectation of private equity outperformance of about 150 basis points. So that's getting the alignment between the capital market assumptions and the benchmarking so that that kind of makes sense together rather than having them being not coming together.
And just to add, I would say historically, the industry standard was a premium of around 300 basis points. That's changing rapidly. So funds are, like yourselves, adopting lower premium levels today, both to align the private equity benchmark with your forward-looking expected returns and also to address some of the challenges that Ben mentioned about all asset classes being priced higher, meaning forward-looking returns are lower than they were historically.
And the 150 basis points, is that sufficient, not just for illiquidity, also, but for the due diligence, right? There's a lot more due diligence that goes into private equity. There's a lot more monitoring. It's much more expensive, right? Because it's not publicly traded. Do you feel like that 150 basis points adequately captures the illiquidity and the additional cost of due diligence and the risk?
Our judgment is yes, it does, particularly for a fund of the size of CalPERS, which is able to kind of smooth out those expenses across a larger asset base. The expectation for returns is 150 basis points net of all fees and costs, et cetera. And we think that's a reasonable expectation and one that compensates the investor appropriately for additional risks and illiquidity for the asset class.
Thank you.
All right. Seeing no other requests, anything else?
Nothing at this time. Thank you.
Very good, thank you. Before we go on to the next item, we're going to take a 10-minute break for the court reporter, so we'll reconvene at 11:25.